All right, so I'm going to keep an eye on this.
I got some realtors texting me. I'm going to see if they're trying to get in.
Okay, fantastic. So we got everybody in there. And you know what? I'm going to go ahead, see if we can do this on the shared screen here, just for fun and giggles, and we'll come right back.
We got more people texting me. They need the link. Sweet.
Awesome. Because the external, it doesn't sound right. Here we go. Let's rock and roll. I'm with you.
All right.
All right. Perfect. So again, my name is Mike Bott, Andrew Montero. So why are you sitting next to me today? Give us a little bit of resume on who you are, what you do, and what makes this thing work.
I'm sitting next to Mike Bott because I got one in the waiting room because I'm highly qualified. No, because we do loans, and I'm Andrew Montero from Modesto. I see some of my partners in here. Thank you guys so much for joining. So I service really everywhere, but my main catchment is the Stanislaus, Manteca area. I was born and raised in Manteca. My office is in Modesto. Got a small mortgage team of 3 people, and we've done quite a few CalHFA over the last 3-4 years or so. That's kind of what I was introduced to. So I'm really excited to share what this new program is going to offer. How about you?
I'm Mike Bott. I'm from the Stockton Summit Funding Office. Been a loan officer for coming on 7 years now. Pipeline yearly ranges between 60 and 100 units. And to be honest with you, CalHFA has been, 20 to 30% of my pipeline every single year. It is a fantastic program. I don't mind using it so long as the client knows exactly what they're getting into. And what we put together today by the help of, our district manager, Blake Eagle, thank you for the PowerPoint, is to make sure that when you guys see this program or get asked about this program, you at least have some knowledge that you can revert back to. And we're also going to talk about co-marketing, a couple of points on that, so that way you can sell us to your clients just even that little bit better to get that client pushing forward in the right direction. All right.
Awesome.
Okay, cool.
Let's do it.
Awesome. All right. So for the agenda today, we're going to talk about what is California Dream for All, how does shared appreciation work? Is this a good idea? There's a lot of pros, and I'm getting a lot of cons as feedback from my agents. So I really want to tackle that.
So we're going to actually ask you guys what you feel about this in the end, so that way we can keep adding to the pros and or cons about the loan. So be prepared for that.
Absolutely. Any questions, as always, type them in the chat. We can kind of tackle those as we go along. Loan program details. Now, the one thing that we do know about this program is none of the guidelines have been released yet. So, but with our history with CalHFA and how many loans, we've kind of deduced and made up our own guidelines that this program will follow. Interest rates, we don't know what the interest rates are going to be at. Income qualifications, we've got in print from CalHFA where they've hinted at it. And then, of course, little other odds and ends. Yeah. And then, of course, marketing, and then Q&A towards the end. So I'll let you take this one, Andrew.
Sweet.
Tell us about the Dream for All.
Okay, so the Dream for All is, you've heard it's 20% down, but the other side of that is shared equity. So what does shared equity mean? Shared equity means that when you purchase the house, yes, they're going to give you 20%. And the examples we use, it's $100,000 in the example that we use. Now you can scale that to any size, and we're going to dive into that. But the kicker, I don't want to say kicker or caveat, but the other side and how this works and how the state is able to lend this incredible amount of money and how are they paid back? They take 20% of your equity. So we'll unpack this a little bit more, but a very quick example is if you buy a house for $500,000 and it appreciates to $600,000 over the next X amount of years, not only do they want their 20% back, but they're going to take 20% of that appreciation. I know that sounds funky, but when we unpack this, you're going to see the gargantuan benefits. Is that a word?
Yes.
You're going to see the huge benefits of them taking their appreciation back and what it can do for your buyers, or if you're not a buyer, or if you're maybe a buyer, like how this can help you as well.
Yeah. It goes back to alligator chomps. Like, what is a percentage? What is 20% of $100,000? You know,
20,000.
like
I don't know if that was a real question. I was like, you're gonna make me do math live on the internet?
Yes, absolutely. But you know, and we're going to show you real examples on how this is going to work. So when we talk percentages, I know I hated percentages until I started this job, realistically.
Right.
And so we're going to get into all of that. So it actually goes back to how does shared appreciation work? Shared appreciation, this program is going to really focus on, let's say Andrew and I are blood brothers. You give me $100,000 so I can buy this home. I already saved up 25 grand to pay for some of my closing costs or all of my closing costs. And what I'm going to do is pay my closing costs out of my pocket, use your 20 grand as my down payment. And then my loan amount's a lot lower, making my monthly payment lower. I'm avoiding PMI. And
price is higher.
And the purchase price is higher. My buying power is higher. But what really happens is when I sell this property, let's say I sell it 5 years later down the road. You let me borrow that 20% down payment.
What's in it for me?
What's in it for you? You know, you say, hey, Mike, you know, I love you and all, you're my brother, you're my blood, but at the same token, I'm going to loan you this money. I don't care how long you keep it, you know, as long as it's within 30 years that I get paid back. And then, you know, of that money that I invest in your home on your behalf, you give me 20% of that. So that's all they're asking. So when you look at that at that vein, it's really a great program where you're co-buying a home and you walk away with something when it appreciates. And so is the person who helped invest it in you to buy that. And best of both worlds, you don't have to live with them.
Yeah.
So you don't have to live with CalHFA or your investor. So since you don't have to live with your CalHFA or investor in the same home, you get all the benefits. So it's a really great program the way they have structured it. All right. So do you want to take this one?
Sure. So
All
here's our first shared equity example. Let me get down. Okay. So in that same example, here's where the numbers are going to start to click. If I'm looking back and forth, we've got this really cool setup where we've got two monitors, but our camera's right in the middle, and I've also got a cheat sheet here. So if I'm looking all around, it's really just us in a giant empty room.
They're screen sharing. They're not looking at you.
Oh, okay. Yeah, don't look at me. Okay, so here, first example, this person is going to buy a house for $500,000.
So you pre-approved me to purchase a $500,000 home, and I'm out looking, and I buy it for $500,000.
$500,000, right?
All right, awesome.
So if I told you you needed 20% down, you need $100,000. Do you got 100 grand?
Well, 100 grand plus closing cost. Yeah. I don't have either.
Okay.
Oh, wait, take it back. I got 25 grand in this example.
Okay, cool.
25 grand.
So he's pre-approved. He's going to buy a house for $500,000. DFA, again, is Dream for All. We're going to use that acronym time and time again. They're going to give him a freaking $100,000, like 100 grand there.
I'll take it.
Right. So his loan amount is $400,000. Your loan amount is going to be $400,000.
So my payments are going to be based off $400,000 at whatever interest rate CalHFA says.
Yep.
So if I were to use a standard CalHFA loan, the ZIP and the My Home combined,
you might get, what is that, 5%?
Yeah, ish.
Yeah.
Ishy-ish.
Yeah. And this is 20%.
So my loan amount would actually be $485,000. So my monthly payment using this program is a lot lower, and we're going to get into that, but we're financing so much less that it's making that monthly payment last a little bit longer.
And another big piece of that is 20% down. Everyone knows that's the magical number that everyone thinks they need to avoid PMI, which it is. And then we'll show you some ways around that. But
hold on. You said another acronym that we haven't digested.
PMI.
PMI.
I think everyone here knows what PMI is, but in case you don't, it's private mortgage insurance. It's the insurance that only protects the bank in case you default on your loan. So it's not sexy. It's not cool.
No, it's extra money that you won't get back.
Yep. Absolutely. All right. So let's go to the next one. So 5 years later.
So I'm sick of this house. It no longer fits my family. You
had 3 kids.
Jeez, don't remind me about kids. We had 3 kids and we only had a 3-bedroom home. So now I've got to sell this property, or, I got transferred to Texas with my job. Now I got to sell the property. Now what do I do?
Okay, cool. So you're probably wondering, where does that 100 grand go? Or how do I pay it back? What do I owe? What's the caveat? What's the catch here? Well, if you take a look at this, in 5 years, let's say your house appreciates to 640,000, which over 5 years, that's about 2.5% to 3% per year.
And it's a conservative number. I think why we're using this example is we had a record amount of appreciation the past couple of years. We expect that to level off, below the average, which is 3 to 5%. So in this example, we're using 2.5%, just to kind of keep everything even keel.
Yep. So your house appreciates 3% over the next 5 years, brings your home value to $640,000. So that's $140,000 in total in appreciation. So one step below, this is how it breaks down. Out of that 140, your total appreciation, the Dream for All program gets 20% of that. 20% of 140,000 is that 28,000. So they made $28,000, and we're gonna elaborate on that. But you still made $112,000. So over 5 years, $112,000 is your money to keep.
Sweet.
Yep. That's for the down payment, which we haven't even talked about what your initial investment was.
Yeah.
Now, if you're concerned that they're taking the 20, go ahead and go to the next one. They get their $28,000. And then if you remember the initial 100,000 that they gave you,
That 100 grand that you let me borrow.
exactly. That totals $128,000.
So I'm paying them back my share of the appreciation, which is 28 grand, and the loan that they gave me at the beginning, which was 100 grand. So 128,000 back to them.
But that's
Gotcha.
only when you sell the house. So it's not like, crap, I got to come up with, you're looking under cushions and all that. No, it's not. You don't have to go out and work extra hard
Yeah.
to make that 128. This is only when you sell the house
Gotcha.
or when you pay off the house.
So,
So you got 30 years to think about it.
yeah. And so we have an inside information where we actually have a loan officer who shared some of the guides because he got a secret copy of the book. I don't know how he did that. But he actually said that it's going to become doable. So let's say you pay off the home or you let it stretch, no matter what, 30 years is when you're going to have to pay it off. So at that point, you can have some options to refinance the home, do whatever you need to do to, prolong this a little bit longer if you need to.
Yep.
And if you don't want to have to sell the property to pay off that DFA loan, excuse me.
So you guys be thinking, I'm sure you guys have questions as we're going. Go ahead and drop them in the chat. We are going to have a Q&A afterwards. I just don't want you to forget your questions if we're going to see them start to come up. Okay, go ahead and go to the one last thing right there.
All right. So right here, it says homeowner equity. Now, I thought I had 140 grand, but you're showing homeowner equity at 142. Where's that coming into play?
So in those 5 years, you're not just sitting there, you're still making your monthly mortgage payments.
So of course I want my credit score to go to trash.
Exactly. You want to be able to buy another house, right?
Exactly.
So over those 5 years, by making your normal minimum monthly mortgage payment, PITI, principal, interest, taxes, and insurance, you're expected to pay, the math would show about $30,000 more. So we don't want to forget about the hard work, the equity that you put into the home.
And I'm making that payment.
You're making the payment.
And that loan is still coming down.
Yep. So your $112,000 in equity from your house going 3% per year for 5 years, you get 112 plus the 30 that you've paid down, you've effectively got $140,000 in equity. So at the same note where you're thinking, man, I got to pay back, this 100,000 and give them their share, you're walking away with $148,000 when you sell this house to be able to drop a big old fat down payment on your next house.
So no matter what, in an appreciating market, we've got a question here in the chat, which is a fantastic about depreciation. We'll get to that in a second. But in an appreciating market where we take into consideration that the home is going to appreciate and we're going to transfer that equity, you're still walking away with the big chunk of change.
Huge.
Okay.
And I think where the big aha or the big nice is going to come is, looking at this, you're seeing 128 go back to the DFA and 142 come to you. When we go to the next few slides and we show what our clients are actually coming out of pocket with, these numbers are going to be like, sign me up. How do I sell my home, wait 3 years and do this program because I want it too?
Exactly. Okay. So Trish asked everyone, what happens if the house depreciates in value? So that is a very real possibility. If we were to hit another 2008 housing crisis, which obviously, by the books and the fixes that have happened in the mortgage industry have done, it's pretty rare that it's going to happen. But let's say everything stays flat. I bought a home for $500,000 and then I have to sell that home for $500,000. When we all sell the home, we know we have to pay for commissions, at least in our market where it's traditional. So we're going to be in that hole a little bit. And then we're still going to have no appreciation. So we're not going to have that 20% share. I mean, if your home appreciates in $1 in value, you have 20 cents of appreciation to pay back. And then you have to pay back that $100,000 loan. So in that scenario, it would be a timing issue if you're forced to sell your home. And then what I would say in that scenario, if I was sitting in that, I would hold on to it until I have enough appreciation to at least walk away. without having the home go into foreclosure. So it's a very real possibility. But in the best case scenarios, they've designed this program to not purposefully put you in a negative selling position with the anticipation that inflation's still going to happen as well as appreciation. So,
and I think my guess is, because that is such a common question that we're getting, is I think when the matrix comes out on Monday, I'm hoping that they paint some picture of what to expect,
or forgivable percentage or forgivable amount, if something bad were to happen.
Yeah.
And there's a lot more that we still need to get to. So hopefully that answers your question, Trish. If not, feel free to chat some more. So here is one of the other items that we kind of touched on before we started the recording, is that how sustainable is this program? Because the state of California, this is California Housing Finance Agency, so it's a nonprofit and benefiting those California residents. How to make it sustainable? Because in the other programs with the My Home and the Zip, what happens is that you obviously have to have an elevated interest rate. So that's one of the cons about this program. We're expecting an elevated interest rate. So that pays back into the program. And number two, that loan gets paid off when you refinance or sell the property. In this program, what they're doing is they're taking a larger share. Hey, they're doing that YouTube trick, scaling your business. So what they're doing is they're scaling their business. Instead of putting, you mentioned earlier, 5% on a My Home and a Zip program, they're putting 20% investment into your home and expecting to get 20% back. It's unrealistic for them to charge you 20% interest,
right?
But it's a silent second in reality, and they're going to get 20% of whatever it appreciates. So it's a little bit of a gamble. But when you sell this property back, so those Dream for All funds are going to get recycled. They're going to be put back into the program. So in this example here, where I had to sell my home for $640,000 and I walked away with the $142,000 minus fees, of course, somebody still had to buy my home for $640,000. And if they use the same program with appreciation, how it went, they're going to get that $128,000 in a Dream for All loan. So the sustainability of this program is definitely a big portion of it. And John King, another great loan officer with Summit Funding out of our Roseville branch, he stated that California and its investors are going to be dumping billions with the B into this program to make sure it's getting off on the right foot and there's enough funds out there, and it's expected to be a long-term program. It's going to be crazy the first year, but I think once things settle down a little bit, there's going to be a constant stream of, hey, this is sustainable and it's going to help out get more buyers into homes. All right. So how can the funds be used? Obviously, when people look at these programs, they think 20%, especially first-time home buyers who may not have all the information. And it's our job and your job as well to educate them. 20% is all I need, right? If I'm buying a $500,000 home, I only need $100,000 to close. Are we right or wrong?
Overall?
Yeah.
You need more than that. You have closing costs.
Oh, I got closing costs. What are closing costs going to be?
3 to 5% more, 3 to 6% more.
Okay. And it's our job to educate them on that. So this down payment assistance program can be a combination of down payment as well as closing costs. We can finance up to 105% of the value of the property. So let's say our loan, we can actually close with a higher loan amount than the property is worth. The minimum loan amount is 70% of the property's worth, meaning if I have 10% cash money plus my closing costs 3 to 5%, so basically 15%, and using this program at 20% down, I could put more down payment on this program to make that monthly payment lower.
So you're saying you can take the state's 20% and you can put an additional 10% down, so you have a 70% loan to value.
It's like 30% down.
Yep.
Yeah. What's the quick webinar math on that? That $500,000 purchase price times 0.3, it's $150,000 you're putting down, and you're keeping that loan amount low. And what's the benefit of that?
Lower payments, higher purchase price.
It gets that payment to that comfort level, so I can afford 10 Starbucks a day. I can afford to buy that new car because my beater Corolla is not really getting to work on time. There's a lot of different ways that the buyer looks at their long-term goals. All right, so let's see here. Can't see the name because I maximized this. So someone asked, I thought it was a low funding and limited time only. We have insider information where everything has been relayed to that person who has relayed it to us. So it's kind of third person. That's going to be a sustainable long-term program.
They set a limit, right? Is it like half a billion right now?
Yes.
Like 500 million is what they're doing this first run. And I think where the question came from is maybe it's limited for that time, but in the time that they're getting, people starting to sell, like they're planting the seed now. And as people sell or pay off their homes in the years to come, it's going to replenish this program probably tenfold.
Yeah. John King specifically said the investors are planning on putting in billions.
Okay.
So it for right now, there are limited funds. However, they are in the works of getting as much funding as they can for this program.
Sweet.
Take only what you need. So these are ratios. Again, that AMI adjusted median income is you pay back a 1-to-1 ratio over 80% adjusted median income, and then 0.75 to 1 under 80. So that goes back to the beginning.
So what did that last client just pay? I'm going to do that quick math for everyone just so they can see. So I want to paint a picture because these are numbers that make total sense in a lender's head, and we spout out AMI, all of this LTV, CLTV. We spout this stuff out all the time. Yeah. Oh, for what?
That's the 15%. So going back to my purchase,
so $140,000. Is your equity, right? Do you want to go back to that slide so I can show them real quick?
If I can figure it out. It doesn't want to do
Okay, that's okay. So in that previous, there you go, right there.
Oops.
So in this example right here, $140,000 is your appreciation. DFA is going to take $28,000 because that's 20% of the appreciation.
Yep.
That's for everyone who's at 80% AMI or above.
If to 150.
To 150. If you're below that 80% AMI, which we broke down those numbers depending on your county, if you're below that 80%, you're only going to have to pay 15% of that 140 back, which you did the math, it was 21,000.
21 grand.
Right. So it's a little bit of savings, but that's one more benefit. It's one more, if you fit into that box, it's one more benefit that they're going to give you. So that's, if we go back, if we catch up to the slide that we're on, that's what that little 1-to-1 is 80% AMI and then 0.75 if you're under that 80% AMI.
Yeah. And this is me being candid, not being rude or anything like that. But if you're at 80% or below the median income and you have no debt, it's going to be tough to qualify for a $500,000 home.
Yeah.
So do keep that in mind. Not a lot of buyers are going to.
But they could scale it down though.
Absolutely.
They can scale it down and they can put 20% down on a $300,000 home. If
exactly.
If that in there too.
Exactly. So these numbers are hypotheticals, just kind of showing what the difference is between the two programs. Okay. And then, so we have two examples that are coming up in the next couple of slides. Number one is to increase the buying power of your buyer. So let's say you've got a buyer who is pre-approved conventional, has got decent credit, low debts, qualifies conventional under the standard CalHFA or even their standard program with just money in pocket. We're going to show you how much they can theoretically purchase. Or let's say you're in a neighborhood where you already are at pre-approved where you need to be at, or the max for that neighborhood. We can show you how this can lower your payment. So you want to take this one?
Yep. So these are some of the same qualifications that we've seen. If you've worked with us and you've done a CalHFA loan, these are some of the first things that we go to. And obviously a first-time home buyer is a must. And that means you haven't owned a principal residence within the last 3 years. And that is verified by tax returns. We'll check to see if you've written off any mortgage interest. That also includes if your spouse owns a home and you're on title, even though you weren't on the mortgage, you had written ownership in the home. So that disqualifies you 3 years. Chestnut has joined. So 3 years to be a first-time home buyer. The income limits, we just broke that down. Now here's something that's unique. This is for conventional loans only, but I think that's a wonderful thing because the whole idea is to really wring out the rag and lower the payment as much as possible. And with conventional, we can get rid of that PMI. That's really the main difference there.
And then if you're also wondering why it's not being offered to FHA buyers, even if you put 20% down on an FHA loan, you're still, no matter what, have to pay PMI in two forms. One that is financed with the loan, and then one is on a monthly basis. But after 10%, it gets removed after 11 years. So that's why they really want to make sure that the buyer is really solid under a conventional loan. And here's the thing in our line of work, when we have a borderline FHA conventional buyer, and we introduce this 20% down payment, suddenly we get an approve eligible when we run our underwriting, whereas we couldn't do that if they were at a 3%. 3% down payment on a conventional loan is really tough to qualify for.
Because it's high risk.
Super high risk.
Think about the bank's perspective. I'm not saying you to think like a loan officer, but even me, is if I'm going to the bank and getting a loan and I say, I want this $500,000 asset. I got 3%. I got 15 grand.
A lot of skin in the game there,
but they're going to say, oof. Okay, well, let's look at everything else. And this is where when he mentioned DU or desktop underwriter, this is where they start to unpack every other nook and cranny of your life. This is where they're going to look at your debts. They're going to look at, do you have any derogatories? What's your job history like? Everything else comes under a microscope.
Big time.
If the lower the down payment you put. So sometimes the difference between putting 3 and 5, and this is getting a little off tangent, but this is why 20% is powerful in this case. But the difference between 3 and 5% can be an approval or disapproval.
Absolutely. Now, food for thought. I have had, everyone kind of has a range on credit scores. I had a borrower who was 765 credit score, middle score, had her 3% down payment and reserves. And on a normal conventional purchase, you can stretch their debt to income up to 50% of their gross income. So if they make $100,000 a year, $8,000 a month, $4,000 monthly payment. I could not get that buyer pre-approved up to 50% debt to income. I had to bring down their purchase price until their debt to income was at 43%. Basically, I had to reduce their buying power. Even though she was a clean borrower, I could not get that approval just because of that small skin in the game. So this is really going to be a game changer for those on the fence cases, or even those people who are really clean. But I'm
glad you brought that up, just for the sake, because I know we have a lot of realtors in here, and so often I try and explain like, hey, I got an approval at this amount, but not at this amount. And to the outside looking in, it's like, well, why not? But I'm like, well, because DU said, well, who's DU? And I'm like, it's a risk-based model. It's a computer. It's way smarter than us. And trying to explain, like, sometimes literally paying off a $12 credit card could move the needle leaps and bounds. And that's not a loan officer thing. That's literally how sensitive the back ends of loans can be. So thanks for clarifying something that I feel like I always have to, defend myself on whenever I talk about DU.
Spent a bunch of years doing it.
Yep. Yeah.
And then income limits apply. So here's where we have kind of done some deductive reasoning. We've had
that.
Oh, we did?
Yeah. The 80 AMI and all that.
80 AMI and everything. Yeah.
Okay.
Absolutely. So just to reiterate, there are going to be income limits along with the first time home buyers. What we're expecting the income limits going to be is in San Joaquin County, 127,500, which is 150% of the AMI. The 80% AMI, where you get that little extra shared appreciation, is going to be at $68,000. So big difference there. But if you got two borrowers in the house, both each making, $60,000 a year, $5,000 a month,
literally, right in the average.
Right in the average. You can realistically qualify for this program so long as your debts aren't crazy.
And think about, I want to just we're going to dive into more numbers in a sec. But just think about what you just said. Two folks who make $60,000 a year, so $120,000 a year income. How long is it going to take for that dual $60,000 a year family to save up $100,000 cash?
In this market where we have killer
inflation,
the eggs are costing an arm and a leg. Maybe your firstborn.
Yep. Car payments are $900 a month.
It's tough because you need to get to work.
Yeah.
And if you don't have enough money to save for your down payment on a home, are you going to have enough money to save up on a down payment on a car? And you got to make it work. So this program is going to be crazy. Conventional loans only. We already went over that. Non-occupant co-signers are not allowed. This follows all the other CalHFA programs. They do not allow non-occupant co-signers, co-borrowers. The main reason that we kind of discussed why they don't allow this, like mom and dad, how they can't help you, is number one, they most likely are not a first-time home buyer, and number two, they want to avoid the risk of investors taking advantage of this program, because this program's killer. And if I was your uncle and you needed extra income to qualify, I can jump on there so that you can do it, but you realistically can't do it. It kind of it pushes somebody else aside. So
it's almost like using a straw buyer for someone who, like, if your uncle is very well qualified and he co-signs for me, and I make $14, $15 an hour, but now I've got this super strong co-signer behind me, I don't technically qualify. And what you're saying is it may look like that investor, rich uncle, is just saying, oh, sweet, well, they're getting 20 down from the state. they're eventually going to sell the house, and then he can turn that into a rental down the line.
Exactly.
Yeah.
You can, or you can do the straw buyer scenario. It's like, hey, you need to put your name on this house so we can buy it using this program so I can have an extra rental. You can live in there for a couple of years, or you can not live in there for a couple of years, but I'm going to use your name to do so. So they're just avoiding that 100%.
Yep.
All right. And one of the greatest items on here, take this one.
Okay. No, you explain it better.
Okay, awesome. So whenever we have qualified somebody in the past with the down payment assistance and the interest rates went low, like it did in 2020 and 2021, these down payment assistance programs, they're loans. They have to be paid off when the first loan is refinanced, paid in full, or all 360 payments are done with. Where this program is different is you're not going to have build up $100,000 of equity in our example.
You don't gain 20. So perfect example is you don't gain 20% of appreciation in a few years. That takes time.
Takes a lot of time.
And with the example we used was a little bit below appreciation, where we used 3%.
Yes.
The average is 3 to 5%. So it's going to take a long time for that full 20%.
Oh yeah. It take a lot of times to pay off that loan while you still maintaining no PMI and that 80-20% scenario. So they are going to offer a one-time rate and term refinance to take advantage of lower rates. They will resubordinate, basically take that 20% down payment that they gave you and then put it on the new loan. So that everybody is happy. You can get you can have your cake and eat it too, because there's a lot of people who I had to turn down for refinances at the beginning of 2020 who didn't have that equity to pay off those My Home and the Zip, and they didn't want to come out of pocket. So it's a great term that they're going to add in there. All right, so let's take a look at some numbers in these examples here.
Let's do it. Can we roll with this one?
What's that?
Can we take this one?
Absolutely.
Okay. So here's your first look at the numbers, and this specific example is how we can take your borrower up significantly in purchase price. So this one is all based around purchase price. You're going to see that the payment is going to stay roughly the same, but that $400,000 ticket right there is going to be exponentially higher. So the first example we see is a $400,000 purchase, 3% down, or $12,000. At an interest rate of 6.99, and everyone on this call knows that changes daily. It changes as much as it just changes a lot. So for the sake of the example, 3% down, a 6.99 loan over 30 years is going to bring you a payment of $3,300. And that's a total cash out of pocket, total cash to close of $26,500.
Okay.
So that's conventional. This is a good loan. It's a conforming loan. We do these loans all the time. There's nothing wrong with this. But now let's go to FHA. FHA, we can increase our purchase price a little bit, and the reason why is the rates are going to be a little bit lower on FHA, and they generally allow for you to carry your debt to income ratio up to 55%. So you get a little bit more wiggle room in your purchase price, and interest rates are lower.
Squeeze your dollar a little bit more.
Little bit. But you got that pesky PMI that's not credit score related. So you can have an 800 credit score and pay the same PMI as someone with a 580 credit score. So looking at the payment, your payment goes down maybe $30 a month or $22 a month, and your cash to close is a little bit higher. There's where you've got a higher loan amount, higher closing costs because you've got the upfront mortgage insurance premium that you're paying for. Yep. All right, here's our first look at the California Dream for All. So take a look at the purchase price right off the bat.
Wow.
$100,000.
It's $100,000.
$100,000. That's that $120,000 a year family. I know. I haven't saved up $100,000, and I would love to have $100,000, right?
Yeah. So
from the 3% conventional to 3.5% FHA to a 20% Dream for All, we just went from $400,000 to $500,000. Now let's take it one step further. Let's assume interest rates stay exactly the same, 6.99. Over 30 years, your payment is even a little bit lower because keep in mind your loan amount's going to be different.
Yeah.
And then total cash to close at we'll call it $23,000. Yeah. So the benefit here, you're saving $35 a month, and you're saving about $4,000 out of pocket initially. Now, one of the things we mentioned earlier is how that 20% is the client's to use. With our expertise, we can take that 20%, we can twist, bend, and put it in any direction we want. This next example is
so these are all great examples, like 26, 29, 22, but we just talked about inflation. Like who's got 22,000? What about that first time home buyer that's got $5,000 in the bank?
So perfect example. So your client is, if you're thinking, gosh, Andrew, Mike, this is wonderful, but we've got some clients that maybe don't have a lot of savings or are just coming out of bankruptcy and getting on their feet or whatever. We're going to show you how you can take that 20%, spin it one extra way for those clients who literally don't have a lot of cash. And this is where I was saying, dude, if you've got a credit score, a pulse, and a W-2 job, or just a decent job, go ahead, give it to them. All right. So if we reduce your cash, if we reduce your purchase price by just a little bit, right? Maybe you're thrilled at $475,000 purchase price.
But it's still $80,000 more than the first two options.
You're still light years ahead. And everyone on this call knows that sometimes the difference between a $400,000 and a $415,000 house is a totally different neighborhood that could totally disqualify you. But
bedroom
here we are.
Counts as well.
Bedroom counts, like RV access, all of that stuff. Now, okay, so looking at this no cash needed part of DFA, if we reduce it, keep in mind, we got 20% to use. If we reduce your purchase price a little bit, rate stays the same, payment stays roughly the same, but there's still no PMI on this loan because we can do what's called, and we're getting a little bit nerdy on the lender talk, but this is what we do behind the scenes is there's something called a single premium MI. So we talked about PMI. If you put less than 20% down, the bank sees you as a risk. So they're going to put private mortgage insurance on there to protect the people who gave you the money.
Gotcha.
If you put less than 20% down, we're no longer in that threshold. So now the bank is going to say, hey, you put 15% down, we got to put PMI on the loan. This is where we step in and we say, well, there's another thing we can do. We can pay for that entire PMI up front, so it's not part of your monthly payment. That does cost money, but keep in mind, we reduced your down payment in this example by 5%. And so now 5% of $500,000 is $25,000. A single premium MI is, depending on, it's very credit score driven, but let's call it between $3,000 and $5,000.
So what you're telling me is, okay, so I'm getting 20% of this program, 20% down payment, $100,000 in
assuming at the purchase price.
Yep. So around $100,000. And instead of putting all of that money as down payment, we're going to save a portion of that to pay my closing costs. So my cash to close is $1,400.
Literally $1,381.
Gotcha.
The cost of an iPhone.
So,
and everyone on this call probably has an iPhone,
or an Android,
or an Android. This is a dream for all. I'm just kidding. I'm kidding. But my point is for $1,300 and a strong W-2 job, buying a $500,000 home just seems bananas. And this is exactly the point where I was saying, when we get into the numbers and we start dissecting, if you are client number 4 and you want to put 15% down and have pretty much a no cash needed loan, you're getting a $500,000 or a $480,000 asset for $1,300. And if we go back to that appreciation graphic that we had over 5 years, you walk away with $142,000. Where else in 5 years can you turn $1,300 into $142,000?
Is it 14?
It's hella X's. I don't know how many X's.
$140,000 or 140 times.
It's a lot of X's.
Money?
Yes.
So you're buying a home for $1,400 cash out of pocket, basically your EMD. If you can swing it that low, maybe it's a little bit higher, but you're getting cash back at closing.
Yes, you're going to get cash back at closing. And so giving $128,000 back to the state who literally so graciously helped you walk away with $142,000 to go drop on your next payment where you no longer need the state is incredible. I mean,
so you're walking away with something. You're not using anything to get in under this example.
Upfront investment is tiny. All you need is that W-2, or not. I keep saying W-2. You just have a strong job,
strong income. Because
the kicker here is, yes, you do have to make that $3,300 a month payment. I wouldn't even call that a kicker. If you apply, if you qualify, you qualify, and if that's within your budget, sweet.
And then how close to $3,300 in rent? Yeah, it might be a little bit higher, of course, because of the interest rates and pricing and whatnot. But you're still investing into your future.
Yeah. So the main thing here, since we have this screen up, everyone look at row 1. $400,000 purchase for $3,300 a month at $27,000. Row number 4, $80,000 more in purchase price for the same exact payment and for pennies on the dollar.
Yeah,
sold.
Yeah,
we're gonna end it here. Turn off the Zoom. No, I'm just kidding. There's more, you guys.
That's my part.
There's more.
Okay, all right. So you can also use this as an example to lower your payment. So let's say you've got a borrower in your office who wants to be in a specific neighborhood or a specific price range for tax purposes rather. We all know that real estate taxes are based off of the purchase price of the property, unless some extenuating circumstances do exist. So let's say they want to be in a certain neighborhood, and 500,000 is right around or even above wherever they're ever going to end up. So let's play it this way on how you can use this program to lower your client's payment, or how we can help them lower their payment. So again, we're going to stick with $500,000, 3% down at 6.99%, 30-year loan, monthly payment $4,200 as a baseline. Cash to close, 32 grand.
So real quick, just in case people are confused,
Yep.
In the previous example, we started at 400, showing you how you can get up to 500. In this example, we're going to show you 500 across the board in different programs, and how the numbers below the 500 are going to change.
Yeah, how everything is going to change. Just in the sole purpose of this example is to show you how that monthly payment will change. Let's swing it over to
this is so good. I can't wait.
Okay. I love saying it that way because nobody understands me. So 500,000 on an FHA borrower. Again, interest rates a little bit lower. Government programs are helping out a little bit, but they still have that PMI. So your monthly payment comes down closer to $4,000, $130 savings per month. So a good couple of options here. Cash to close is a little bit higher because you have a 0.5% as a minimum down payment. We're playing with minimums here. Next one, let's input Dream for All. Same purchase price. $100,000 down, keeping our loan amount nice and low. So we're financing less. We're missing PMI. Cash to close it's still saving you at $9,000 in the best case scenario. And the monthly payment is $876 lower. $876 lower.
For the same exact house.
That's a car payment for a BMW or a Mercedes or a Corolla if you get a lot of options. What we're saying is $876 to be saving a month compared to your other options
for the same front door and same toilet.
Phenomenal.
Yeah.
Like where would you put your eggs? Well, I mean, let's not play with eggs because they're so expensive.
I was gonna say, where do we get eggs from? We're on a roll here.
Which basket would you put your eggs in? But
right.
Come on.
I got you.
Okay, so let's say same scenario, but I don't have $23,000 saved up. Well, let's go back. No cash needed. Same purchase price, same interest rate, same 30-year loan. Hey, we're not saving $870, but we're saving $710 a month. Cash out of pocket, $1,100.
What's the difference we did here?
What's the difference? We lowered our cash to close.
But how?
Oh, we restructured it. Thank you. We restructured it. Instead of putting 20% as a down payment, what we did is we saved a portion of that 20% Dream for All funds, and we paid off my closing costs as well as my single premium PMI.
Yep.
So that way, on paper, it looks like a 15% down loan where I spent 5% over here. So I can buy this home for $1,100.
Yep. And so think about this. I'm going to take it one step further. Let's say you do have $30,000 in the bank, and you're like, all right, we saved up, 8 months to a year for this 30 grand.
You saved $30,000 in 12 months?
Is that good or bad?
That's a lot. That's what, like $2,500 a month minimum.
Oh, well, this example must have done that.
Good on them.
Cool. So
it's a lot more money than I'm saving right now.
Right. So, let's say you have 30 grand in the bank, and you're staring down the barrel of option number one. You can make the payment and you have the $32,000, but you're like, why? You can take part in option number 4 is what we're saying. So if that 30 grand is all you've got besides your normal emergency fund or checking account, and you're buying a brand new house and you don't have any furniture or whatnot, and you don't want to
be bankrupt at the end of it.
Or you want a cushion in the bank. Yes. You just want reserves. Tell your loan officer, tell Mike or myself, like, hey, I want to take part in that. I want to, this is my cash. You're telling me I don't have to use it? Heck no, we can use $1,200 of it.
Yeah.
And you can save the other $28,000 or whatever to furnish your home. Or if you're like me, I like seeing it there, because then I just have peace of mind for no matter what comes. Like, exactly. There's so many, it's an emotional benefit. It's a mathematical benefit. It's a house price benefit. There's a ton.
Yeah. And these are only 2 options how we can structure this. We can structure this in a million different ways. Quite literally, a million different ways, different down payments, different options. We could do a 10% down and we finance even up to 105% over the home value. There's so many different ways that we could play and make this worth your while.
That's not even, I'm just thinking as you're saying that, like, this 20% is not a seller concession, it's a loan. So we still reserved our 3 to 6. We can do 6% seller concessions. No,
Yeah.
wait, can we do more than 6%?
I believe it's 9%.
So if you had the guts to, and you realtors, if you wanted to ask for, obviously now we're all the rage is the buy down, right? So we're asking for 2.2 to 4% seller credit. When you put 20% down, that unlocks your conventional loan to be able to ask for a 9% seller credit. Now, I don't know any seller who's going to give you 9%, but do you see how that also opens up? If you wanted to do the 20% down and ask for a seller credit and their cash to close was 22.9 and you got them a $10,000 seller credit, their cash to close just went to 12,000. They're still saving that money in the bank and using all of their 20. Man,
Yeah, well,
I'm getting excited. This is where the loan officers get excited because now this is like a Rubik's Cube that we get to solve over and over again.
Numbers.
Yeah.
Well, here's and one other thing. If you are considering seller credits, let's say they're actually agreeing to some seller credits, as this program takes off and the summer season comes along and everything gets hot again, you can actually buy down the interest rate on CalHFA. And with the current My Home programs and the ZIP programs, you are able to do a 2-1 or a 1-0 buy down. So
can we pair DFA with the buy down? That's got to be illegal. Can we do that?
Yeah,
we can.
You can do it right now. Now, what we have to wait for these guidelines to drop.
Okay.
March 27th to make sure that, hey, all of these things that happen on a standard CalHFA, we can use on this program. We're anticipating we can. We've got very strong motivations that they will be. But there's a lot of ways that we can continue to utilize all those programs and all those benefits to this. Now, buying down the interest rate is not cheap. I did it on one loan last month.
For CalHFA?
CalHFA was a permanent buy down. It was pretty pricey, but it was a way that we could, maintain that deal, keep our debt to income correct.
And when the way you just phrased that too, and I want all of our partners to hear this too, is sometimes it's it may not be the sexiest thing to do, but if your client is in a position, and this is common, right? We're not ones to say, do this, look at this loan, it's great, do it, buy it. No, we're also in the position to say, look, this is a way to get you into a house, to start that appreciation journey. It may not be the best terms now because you just came out of a bankruptcy or your credit or a divorce, or there might be some hardships. And sometimes the not the prettiest way to get into a home is a way to get into a home. Yeah. And so we reserve those for those back pocket 1-2 punches. It's not that we want to give out, they're not even bad loans, but you might think like, wow, this is where my head goes, is like you give a client who this is the one way we can make this work. And then they go show this to their aunt who used to be a loan processor 40 years ago. And they're like, that's high. And it's like, but you don't know the full story. Yep. This is what we're trying to portray, is there's so many different ways that we can put our thinking hats on to tweak this loan and other loans too. If you've worked with either of us, you've been in those conversations where it's like, let me try a few things and I'll get back to you. And that's where we really do go back and we're like, what if? And it's really a puzzle. It's a puzzle. It's just, this is a new tool to add to our puzzle box.
Absolutely. Yeah. And what the way I, initial phone call with the borrower, starting to get the loan application, assessing their needs. If they say, yeah, you know what, I've got $25,000, but I also a first-time home buyer and I want to see what my options are. The next sentence that I say to them is, absolutely, we could take a look at all of your options, including down payment assistance. But there are pros and cons to each. Down payment is a way, if you're forced to get your foot in the door, and you absolutely have to use it to buy your home. Whereas if you use your own funds, that might give you a little bit more leverage down the road. Yeah. That's with the standard program. With this program, I don't think I would steer anybody away from it. Just because you're buying it with somebody, you still get the benefits. Why not?
Yeah. Awesome.
All right. So we're towards the end of our presentation. Everything is going to launch on the 27th. I personally have at least 5 shoppers out who are pre-qualified with this program based on what we know about it at the moment. The only thing is up in the air, like we mentioned, are going to be the interest rates and the exact details like debt to income, but credit score. I honestly, I don't think there's going to be a credit score limitation. They're going to just default to what Fannie Mae allows. Okay. So that might be moot, or 680 or above. So for the clients that I have out there looking, they're already utilizing this program. I'm showing them the worst case scenario. So I'm showing them a way high interest rate. Numbers all still work, and cash to close is within their means. Yeah. If you want co-branded marketing material, we can get that out to you. Not today because it's kind of late, but I mean, send us those emails. Take a screenshot of the screen here And what we can do is we can get that co-branded material so you can hold them at your open houses. All right, so now we're going to open up the forum to everybody to have any questions. Let's see if I can stop share. All right, awesome. So if you have any questions, feel free to even unmute yourself or type it in the chat if you're a little bit shy, but we're here to help you make money.
Hey guys, thanks for presenting today. It's a lot of good info.
Absolutely. Thank you for joining us. We appreciate it.
Yeah, for sure. I had a question, so I might have missed this. I think you kind of breezed over it, but if the buyer goes with this loan and then they decide to refinance, say 5 years later, do they do an appraisal and determine the equity share and that's paid out there, or is it just the loan that they'd have to pay back with the refi?
So they are allowed one rate and term refinance to recast their first loan. At that point, it's not paid and doable or payable and due. What they're going to do is they're going to resubordinate that $100,000 shared equity loan. So they're going to resubordinate it onto the new one, basically attach it as a silent second. One time. Mm-hmm. So let's say a client wants to take cash out. They have a massive equity 15 years down the road. They want to pull that out. On a cash out refinance, it will definitely need to be paid off. So I would keep those notes down there for either one of those options, but they could take advantage of lower rates, but they don't want them to take out more loan or anything without having that shared equity loan paid off.
Gotcha. So if they wanted to just refinance out of it, then at that time they would determine the value and the equity share would be paid back.
Exactly. They would do an appraisal at that point to determine that that share that they would have to pay.
Awesome.
And then Trish has one in the chat. So shared appreciation towards the end of the loan, how would you obtain title? Appraisal to pay the initial 20% and the current market value for the 20%. That's exactly it. So whenever that first loan is paid off, that second loan, the shared appreciation loan, is a balloon loan. So it's all due at that point. They would conduct an appraisal, whether it be a drive-by appraisal or whatever software that CalHFA uses. They'll take that 20%, we'll get that payoff, and then we pay them off as part of that loan. Or they will come after you, the buyer, the owner of the property, to get that paid off. A way to around that is, let's say we've got a year left on the loan, and year 29. You're going to obviously have a ton of equity in the property. Pull cash out, pay off whatever's due on the shared equity loan and the appreciation based on that time frame, and you can extend that loan a little bit longer. That's one of the workarounds if you don't have, all that money at that point in time.
Good call.
Yeah.
Any other questions?
Any other questions? Feel free to unmute yourself if you want, or type them into the chat.
If I want to go back and rewatch this later, you said you will be on your YouTube channels?
Yes, absolutely. Let's do this here. I'll do it on mine. What's your YouTube channel called?
Just say I am Andrew Montero. Mine's heavily photography based, but we'll throw some nerd math in there.
Just like that.
YouTube.com/
like that.
Bam.
Boom. Okay, so that is Andrew's. Mine is, I don't have a fancy handle. I think I do. I just don't remember it off the top of my head because I'm on there so much. Mortgage Better with Mike Bott. I think I'm the only Mike Bott on YouTube.
Is that your youtube.com/ Mortgage Better with Mike Bott?
I think so.
Okay.
Think so. I'm not positive. So these will not be posted tonight, but we will get them posted probably in the next day or two, so that way we can revert back. Also follow us on Instagram. I am Mikey_Botto. We're going to be posting little clips of this because there's a ton of useful information here. Like I said, we may not be correct about 100% of everything, but our history with CalHFA being such a big part of our pipeline and our line of work, we know what is going to be coming out.
Right. Oh.
You're welcome, Yuzma. Thank you so much for joining us.
Uzma, good to see you.
All right. Well, if nobody has any other questions, we want to say thank you so much. Give us a call if you have any more direct questions. Message us, email us, whatever you need to do. And that's what we're here for, right?
Yeah. Definitely. Yeah, Lori, go ahead and email me and I'll get some stuff made for you. I got to figure out where we make it, but apparently we have flyers. So
Your wife.
oh, sweet. My wife will make me some flyers.
We'll make sure it gets happened. Yeah, feel free to email us. You rock too, Travis. Thank you so much. Cool co-branded stuff as well.
Got it.
Absolutely. Email your requests. You know our phone numbers, you know our emails, and we'll be there for you.
All right.
All right,
Trish,
you guys.
thanks for coming, Trish.
Thank you guys.
Bye.
Thank you so much. Appreciate it, guys. All right. Awesome job.
Let's do it.
Yeah.
Oh, we did it.
Yeah.